All right, folks, welcome to Investing for Beginners podcast. Today, we're going to have a fun show. Today, we have our friend Whit Hughley, who is the portfolio manager of River Oaks Capital. He's here to talk to us about small caps. So if you are interested in small caps, microcaps, like I am, this is not an area I've invested in, and I want to learn more. So I'm curious. And Whit is the guy to help us understand all of this because he's a smart dude and he's been doing this for a while and he knows a thing or two. So Whit, thank you very much for joining us today. And we're looking forward to having a good convo.
Yeah, thanks so much, David. I appreciate the inviting me on. I'm super excited to talk about microcap and small cap companies and hope your listeners and you can learn a little bit about what I've learned over, I guess, a 10-year investing career now. So,
Yeah, well, this is going to be fun. So let's start with an easy softball question.
Sure.
You can invest in anything, right? Real estate, gold, Bitcoin, stocks. Why do you choose stocks?
Yeah, I think maybe it's probably easiest to just go back to square one. For after I graduated college, I worked for a startup company, and the startup company was based around food delivery. Nothing to do with investing at all, but I got extremely interested in what it took to operate a day-to-day business, kind of behind the scenes, what it takes every single day. But at the same time, I realized that I wanted some more background in financials, business acumen. I noticed I lacked on that side. So I wanted to kind of beef that up, for lack of a better word. And so I went back to get my MBA here at Tulane. And the goal was, I remember saying it the first day, the goal was to start my own startup company because that's what I was interested in at the time. And I took an investing course the first semester. I read The Intelligent Investor, read everything by Warren Buffett, and everything just changed immediately. It was like a complete course change or life change right there on the spot. So I guess just to fast forward a little bit, those 2 years of getting my MBA, I bet you I read close to 100 investing books, all the ones you've probably all heard of: Warren Buffett, Joel Greenblatt, Seth Klarman, Howard Marks, you name it. I just could not get enough of it. And I ended up going to work in California for private equity once I graduated. At the same time I was getting my MBA, I was just doing everything you could possibly do in finance. It became totally enamored. When I moved out to California, the companies we invested in were obviously, it was a private equity company, so they were obviously private companies, but they would be considered small or even micro-cap companies, to be honest. And I realized how inefficient these markets were. If you were willing to do the due diligence of going to visit these companies in person, kind of doing the scuttlebutt, talking to industry experts, you really could find some inefficiencies in the market. And interestingly enough, I didn't realize it at the time how lucky I was with the opportunity I got in private equity for two reasons. One, it was a rather large private equity fund, but it was a small deal team. So I got to do anything and everything. I got really lucky on that. I got to visit management teams, go to conferences, help raise money, you name it, I got to participate in it. And, the second part that I got really lucky about is that the model we had at the private equity firm I was at was pretty unique in that we were only buying about 30 to 49% of the company. We were never coming in and taking over the entire company for the most part. So it was extremely similar to public investing due diligence because the management team was staying on board. It's basically the exact same due diligence you do for a public company because we weren't really replacing any of the prior management or the current management team. So, I guess it was about 2 years into private equity, maybe 2.5 years in, I started just looking at microcap and small cap public equity companies. And I was just fascinated that they were even more inefficient than they were on the private side. I couldn't believe it. And I think some of that's for good reason. A lot of the microcap companies public microcap companies are not great companies, are not well run. You'll probably never generate an adequate return. But there are some gems in there for sure. And if you do that private equity due diligence of going to visit management teams, doing your rigorous due diligence, of going to conferences, talking to industry experts, talking to competitors. You can find them, but it certainly takes a lot of work. But it was always my goal to start my own fund. And then once I started looking at microcaps and had already had the experience on the private side of being in what would be considered microcap companies, I knew that's where I wanted to start the fund. So started investing family and friends' money on the weekends whenever I had time, and then ended up moving back home to New Orleans from California and started the fund on January 1st of 2020. And
good timing.
Yeah, we could certainly dive into that later. But what I was shocked by was I did the same. I wrote about it in my most recent letter. I did the same rigorous due diligence we did in private equity. That was just already in my DNA. I wasn't going to buy ownership in a company, in a public microcap company, even if we were only buying 1% of the company. I still wanted to visit the management teams. I wanted to go to conferences, do the rigorous due diligence we were doing on the private equity side. And when I was showing up to these microcap companies, they were like, "You're the first investor that's been here in 5 to 10 years in person often." And I really, that was my first aha moment, was I could provide value to my investors here by just doing the work that most people don't want to do, hopping on planes and going to visit people in person and going to kick the tires, for lack of a better word. And, I think that's good for two reasons. A, you'll find a company that's trading at 5 times earnings. You're ecstatic. You can't believe how cheap it is. There's extra cash on the balance sheet. And you fly out to visit the management team and you realize immediately, oh, this is totally uninvestable. Because there's been no analyst covering the company. There's been no eyeballs on the company. And then you walk into a situation where you realize this company is just set up to pay the CEO salary, to pay the board fees, and what happens with the rest of the excess cash, you'll probably never see it. And unfortunately, that's a frequent occurrence in microcaps, unfortunately. But then there's the flip side of the coin, which probably happens once a year to once a year to maybe 3 times a year if I'm lucky, where I hop on a plane. And it's a example I use often. This was about 4 years ago, and I visit Dayton Judd of FitLife, and it was trading at 5 to 7 times earnings at the time, or PE ratio. And I sat down within 5 minutes. I was like, oh, Dayton could run a Fortune 500 company. This is a totally undiscovered gem here. He was just a wonderful manager. And, I could dive in more into the importance of management teams in microcap companies, but that makes all the travel worth it, is when you find a Dayton Judd out there, because they can just produce astronomical returns if you can find what I call an A+ capital allocator, although there's probably only 50 maybe in all of the microcaps in the US. They are out there. You just got to really get on the road and dig. And then the second aha moment I had, and we can dive into this more later too, is what I would call suggestivist investing. And that's something I've more done over the last 2 years. So I've been running the fund for almost 5.5 years, where in no way am I visiting companies and saying, if it's a bank, you should lend to this company, or you should fire this employee, or anything like that. In no way. I'm developing a very good relationship with the management team, because most of these companies we've owned for 5 years now. But I am suggesting buying back shares a lot of the times, or divesting of non-core assets, or improving investor relationships, or debating whether or not it's worth uplisting onto the NASDAQ. And, a lot of these companies we own are trading at 50 cents on the dollar. And, there's no simpler capital allocation decision than to buy back shares at that valuation. You're turning $1 into $2 immediately. And I've been really pleasantly surprised at how much that suggestivist investing has worked. And, that's kind of the second way I view that I can provide value to my investors, is really develop a deep connection with these management teams, so that, 3 or 4 years down the road, when I start making suggestions such as, I think it really makes a lot of sense to be buying back shares right now instead of acquiring another company or reinvesting into the company. They know that I'm not doing that just to try to get the price to bump up real quick so that we could sell. They know it's genuinely because I think what's long term the best idea for the company. So that's kind of hopefully gets you up to speed and brings you to where I am 5.5 years into running the fund.
Yeah, it does. There's a lot of good stuff in there. So let's start with why. One of the things I'm curious about is why would what's the difference between investing in maybe large cap or mid cap companies to microcap as far as like investors and how we approach the idea?
Yeah, I think the biggest, I mean, there's so many differences, but probably the biggest, I mean, the one that jumps out first, I wouldn't say whether or not it's the biggest, is how to find the idea. It's very much boots on the ground type of work that I was talking about, flying across the country. And, you know, there's no analysts covering these companies. And if they are covering the company, it's more or less they're just reproducing the 10K into a research report. It's nothing that helps you gain any further insight that you couldn't from the SEC filings. So really reading research reports and that type of thing really doesn't help much from my experience, at least. And also screening really doesn't help much from my experience as well. There's almost always some quirky thing going on within the microcap company that doesn't make it screen well. And if it does screen well, it's probably already been discovered by some quant fund anyway. So what you really want to do is find these companies before they screen well. But so I've really had no luck with research reports, screening, kind of the traditional way you would find a lot of mid cap and large cap companies. It's really, the way I look at it, it comes down to two options. You either brute force of just reading A through Z, going through every single company, and most of them you could kick to the side pretty quickly. Or what's worked better for me is I have a network of investors that I exchange ideas with. And so word of mouth, kind of the scuttlebutt that Phil Fisher talks about in his Uncommon Stocks book. And so if I find an interesting idea, I'll reach out to I think it's about 8 or 10 investors that I've made good relationships with that I talk to probably once a month. And I'll say, hey, I just found this really interesting idea. And then they'll share their interesting ideas. And you really curate a nice list of companies from that, because you start to trust and get to know which investors think like you, which investors have done rigorous due diligence as well. So, I mean, a lot of the process of how to find ideas is what people don't want to do. It requires getting on the phone and calling people. It requires getting on airplanes, going to conferences. It's just, and I think that's what makes this market, microcap market, so interesting, is because computers really don't help very much. It really is kind of, if you go back to reading what Warren Buffett was doing in his early days, it's a lot more of that than it is kind of being able to sift through screens, look at return on equity, look at return on invested capital. I just had no luck using that type of process. So I think that's probably the biggest difference that jumps out. But I mean, there's plenty of other differences. Liquidity, you name it. It's just a totally different market.
Do you feel that's great stuff? And do you feel that it's hard? Do you think it's harder for people that are used to investing in, Apple, Visa, Google, whatever, to shift to that kind of investing? Do you think it's, or can the skills overlap?
Yeah, I mean, I think the hard part is, I think probably the hardest shift is going to be around, you really need a long-term ownership mindset, especially if you're going to have a fund in this area where you're owning maybe 1% to 5% of the company. I can't wake up this morning and say I want to sell this company. It doesn't really work like that. It's not as hard as you would think, but I certainly couldn't do it in a day. Whereas in Apple, I could sell my entire stake in 1 second,
right,
if I wanted to. So that's really why I do such rigorous due diligence. is because I'm really thinking of it more as a private equity investment where I want to hold this company 3, 5, 10 plus years. A lot of the companies we bought at the beginning of starting the fund, we still own. So I think you have to have a long-term mindset here, or it just won't work. Because I mean, if today I woke up and said I wanted to sell the company and I have to sell it today, you're going to make the share price go down a significant amount. So I think that would be the hardest adjustment. And then the other hard adjustment is what I talked about already. And I'm not saying that large cap and mid cap funds don't already do it, but I think what they do less of is directly talk to and get to really develop a relationship with the management team. And I think part of that's probably makes sense because I think the management teams are a little less important for larger companies. For smaller companies, the management team is like, if I had to put a number on it, I'd say 90+% of the outcome of your investment is going to be based on the quality of the CEO and the team around him. So I think that there's a way more qualitative analysis that has to go into investing in microcaps, whereas when you get to larger companies, which I certainly looked at, I mean, I was at the Berkshire Hathaway meeting this weekend.
Oh, awesome.
I certainly look at larger companies. I don't invest in them, but it feels way more numbers oriented than qualitative and people. And, and that's what I learned at private equity. Investing in smaller companies is there's just so much more behind a 10K in the income statement and balance sheet and cash flow. There's people involved in the business. There's the day-to-day troubles that come and go with running a business. I mean, it's run by humans. Humans are flawed individuals. You're going to make mistakes. Whereas as you get to larger companies, they're a bit more on autopilot and have less of a reliance on some of the qualitative aspects as far as people and management teams go.
Right. Yeah. I sometimes get the impression, and you can correct me if I'm wrong, I sometimes get the impression, especially on X, so you can take that for what it's worth, but that when people are talking about smaller cap or micro cap companies, they're looking for air quote 100 baggers. And that's always the intention. But I'm getting the sense that what you're talking about are really just finding really great businesses and buying them and not worrying about that kind of, intention. Am I right or wrong about that?
Yeah, that's definitely how I think about it. I mean, obviously, if one of my companies becomes 100 bagger, I'm not going to complain by any means. But I think you'll see a lot of microcap companies that are just trying to compete in too large of a market. They want to be the next Tesla. We're going to be the next electric car. We're going to be the next Apple. We're going to be the next Google. What I'm really looking for is companies that compete in obscure, off-the-grid markets. Whereas when I'm reading their 10K, I'm like, I barely even knew this market existed before. Because I think it might be less of a moat and more of just a remote island that no one even wants to go to. And that's how I think about it, is just looking for these obscure, off the beaten path markets. And within that, you'll often find they're very fragmented. They're often run by mom and pop owners. So if you find an A+ CEO, which, as I mentioned, are few and far between, but they are out there, microcap, and you plug them into one of these fragmented mom and pop, small, obscure markets, they just end up running circles around their competition because most of their competition is just there to collect a 9-to-5 salary. They're C- CEOs to give them a grade, but and then so this A+ CEO comes in, and I have some of the companies I recently bought ownership in. Innovative Food Holdings, I think, is a great example where Bill Bennett comes in, and his background is in Walmart, Kroger. He has an extensive background that you would not find in a typical microcap CEO. And you plug him into this inefficient specialty food distribution industry, and the business itself it does have somewhat of a moat, but it really doesn't even need that much of a moat because the management team becomes the moat because they're just so much better than their competitors. And the nice thing is that the market is large enough for us to generate really good returns, but it's not so large that some major competitor is going to come attack them because it's not even worth their time. If a major competitor were to want to enter the market that Innovative Food Holdings is in, they would just buy the entire company out. They wouldn't even waste their time competing against it. So I think you're right. I think, at least for me, searching for 100 baggers in the microcap industry feels more like a venture capital type approach. And I'm trying to use a Warren Buffett, Ben Graham value approach. And I'm sure there are 100 baggers out there. I know there are. I've seen it happen. But you're going to have to be willing to take losses. And I'm not willing to lose money. So that's not something I'm willing to explore.
I love the example. I mean, that's great stuff. And I love the example that I can't remember if it was your shareholder letter or if it was your owner's manual, but you're talking about John Deere and fruit baskets in Florida. Yeah. And I thought that was like the best example of what you were just talking about, because even if John Deere decided to try to compete, it's so little of their revenue. It's not even worth, because of the size of the company, it's just not worth it. And I thought that was a brilliant example.
Yeah. It's, I just made up a hypothetical company in that owner's manual, but a fruit basket company that helps collect oranges in Florida, if John Deere wanted to compete against them directly, let's say they did capture the entire market, that would probably increase John Deere's revenue by 2%, maybe. Yeah, if that. So, they would just immediately just write a check for 50 to 100% premium of the company, probably, maybe, oftentimes way more than that, to be honest, and just not even worry about doing the market advertising to penetrate the market. They would just acquire the company immediately. So that's why that's one of the many attractive factors of these obscure, off the beaten path markets.
I recommended the stock a couple of years ago that's up pretty big. I want to share that with you so you can see the type of analysis that I do for paid subscribers. Download it for free at stockwriteup.com.
Yeah. And I think the other thing that illustrates too is that you talk a lot about the moats, and you've mentioned that several times. Like, these companies are, because they're so niche, that there isn't going to be a lot of, air quote, direct competition for the next Tesla or the next, Visa. Right. And so that gives them an advantage as well. So can we talk a little bit about, you mentioned the whole due diligence thing. What does that look like for you and in the microcap space, as opposed to maybe that somebody, again, is looking to invest in Visa?
Yeah. I think it's definitely a little different for sure. I mean, I start off, I assume the way most people start off are just reading the 10Ks and the 10Qs. If off the bat the company looks interesting, then I'll read multiple years of 10Ks and 10Qs. Get a sense of, especially if they're cyclical, get a sense of what normalized earnings are. Do that whole sort of process. And then if there are any write-ups out there, I'll read them. That's very infrequent, very rare. Oftentimes when I type in a ticker symbol into X, it brings up my shareholder letter. So it's very infrequent that there's a letter out or a write-up out there, which is probably a good thing. If there isn't, probably means it's undiscovered. But yes, and then I'll reach out to other investors who I might recognize on the shareholder list and just pick their brain too. I think the one mistake I made at the beginning of the fund is I probably hopped on planes too quickly to go visit management teams. I got super excited, and I'd read the 10K, 10Q, and within a week would be on a plane. And it was a great learning experience, but it's probably not the most efficient way to use my time. So now what I do is I schedule a Zoom call with the management team, and I could pretty quickly diagnose whether this is worth a flight or not. For instance, the recent company that or a company I bought about a year and a half ago called Trust and Trust. I think I pitched them on a Twitter Spaces maybe a couple months ago that you could find on my website. But within 5 minutes of talking to the management team, it was like, we don't even need to keep talking. I'm booking my flight to Nashville right now. I got it. They immediately, I thought it was a bank. They described to me, we're not a bank. We're a bank with a wealth management division attached to it. I go, okay. Now I understand what I was missing. And I was immediately on a plane. So that's the next part of the due diligence, getting on the plane and directly meeting with the management team. I would just, it's just in my DNA. I would never buy ownership in a company, in a microcap company, without visiting the management team. I mean, I think of it very similarly as owning, if I were to buy 10% of a restaurant here in New Orleans, I wouldn't just read the financials, the most recent audited financials, and say, okay, I'll buy 10% of your restaurant. I would talk to the general manager. I would talk to the 90% owner. I would talk to other restaurants within New Orleans to see what their reputation was like. I would get an understanding of the restaurant market in New Orleans. I wouldn't just make a quick knee-jerk reaction. So that's really what I'm doing. And when I'm flying out to visit these management teams, what I'm really looking for is what I've already talked about, is just that A+ CEO that I call it. I think I haven't written. I've already gone through the example of Dayton Judd, so I don't have to go there right now. But I mean, really, what it is when you sit down with them, they start he or she knows the business inside and out. It's just obvious they have a more tangible grasp on the business than 95 to 99% of the CEOs you talk to in person. But B, when you sit down with them, they're talking to you business owner to business owner. They're not trying to give you a sales pitch on how wonderful their company is. We're going to 100 bagger. It's they're saying, here's what we do good. To use the Dayton Judd Fit Life example again, he said, we're great at cutting costs. We're great at making the company more efficient and the companies we acquire more efficient. But we need a new ERP system. We need to hire some people in this area. So they tell you the strengths and weaknesses of the company, and you just feel like you are talking from one business owner to another, because that's what is happening. You don't feel like you're getting sold a sales pitch, because, I mean, every company has flaws, but microcaps companies in general have a lot of flaws. So if someone tells you that there is nothing wrong with a microcap company, they're just not being honest. That just can't be the case. But I think I keep mentioning A+ CEO. I'm not sure if you've read the book Good to Great by Jim Collins. I think he describes it a lot better, and I wrote it down here. He calls it a level 5 leader. But it says a leadership style that is characterized by a powerful combination of personal humility and professional will, meaning they're highly ambitious for the organization's success, but with a modest and self-effacing attitude. And that's really what I found when I sit down with CEOs. He sums it up in 2 sentences, as most good authors and Warren Buffett can do, something that takes me 10 minutes to explain, but yeah, it's becoming more and more obvious when there is that A+ CEO, and that's really what I'm looking for.
So how do you determine like the whole idea of the A+ CEO, which I really like? How do you determine the capital allocation part? Is it by doing the due diligence and understanding what the business does and what they're doing with the business, or is it more based on your face-to-face conversations or your Zoom calls with management?
Yeah, I think most of it comes from the face-to-face conversation. I certainly go back and look at the historical returns on invested capital, but oftentimes you'll walk into a situation such as, like, to go back to Fit Life or even Innovative Food Holdings, which I own both of, where the CEO has just recently taken over. So the past financials can give you some idea of the moat of the business and the margins it can make, but oftentimes the CEO is taking over because the capital allocation has not been good. I mean, I think the biggest factor to look for is, someone like Dayton Judd owns 55% of the company. So, any expense or any, everything that is run through the company is, if he makes a mistake, he's getting hurt way worse than any of us. So when I think about capital allocation, I think each company we own is a little different. I think to go back to Innovative Food Holdings, I think right now they're growing, so it makes sense to just keep reinvesting into the business. As they get more scale, do the operating leverage, more free cash flow keeps getting generated. So I think it makes perfect sense to keep investing in the business. Whereas there's some more mature companies we own, like a community bank, for instance, that's trading at 50% of book value, where I think it makes very little sense to invest much into the business other than maintenance CapEx. And it makes way more sense to buy back shares. Because, what I've realized is just because microcap markets are inefficient now doesn't mean I'm going to wake up in a year and they're going to become efficient. If the price is $50 a share, it could stay $50 a share for a very long time. So what I'm trying to do through what I mentioned, the suggestivist investing, is make sure that my investors, which includes myself in the fund, are generating a 10 to 15% return, even if the share price doesn't move. And whether that's through share buybacks, dividends, divesting of non-core assets, which would probably result in a special dividend, whatever that may be, is either a suggestion for me or what management thinks is best. But that's really why I've started really implementing this suggestivist investing, is from a capital allocation standpoint. I don't think microcap companies are fully grasping how much of a capital allocation opportunity there is in buying more ownership in their own company. It's most of what you'll hear is frustration around how inefficiently their company is priced, and I'm always trying to say, instead of getting frustrated, let's take advantage of this layup opportunity to, like, I think the easiest way to pitch is that I have come across in management teams is, you're looking at acquiring another company at 10 to 15 times earnings. Why not acquire your own company or more of your own company at 5 times earnings? And I think that starts to make a little more sense when I deliver it that way. But I think that's one piece of capital allocation that's really missed out on in microcap companies, is the ability to capitalize on the inefficiently priced stock. And then, but there's always varying opportunities. And if the company is growing, it perfectly makes sense to invest as much free cash flow as you possibly can back into business.
So how do you think about, like, valuation? So how does that fit into your air quote process? How do you think about that? How important or not important is that to you?
Yeah, no, it's extremely important. It's probably the first thing I always think about. I'm not sure if it's in my DNA or where it came from, but I'm just a value investor at heart, and I just cannot overpay for things. I definitely, my definition of what overpaying is has been redefined as I've invested more. It doesn't have to be a 5 PE multiple right now. If there's a direct line to a further growth, I have no problem paying higher PE multiple. But I think the North Star of what I mentioned is a base case return using very conservative assumptions of 10 to 15% return per year. And when I say that, I mean a 10 to 15% free cash flow yield per year. So, I'm always thinking about free cash flow to equity, mostly because a vast majority of the companies we invest in have very little debt. So if they do have debt, then I would think about it as free cash flow to enterprise, because I don't want any financial engineering to show up in the returns that I'm thinking about. But I think the second part, or maybe even the first part I do, is look at the balance sheet as well. It is very risky to have debt in microcap companies.
Mm.
They're almost always going to be variable. So there was one company I learned the hard way when they were paying LIBOR plus 7.5% in 2022. That looked okay, and then all of a sudden LIBOR goes up to 5 or 6%. I forget how high it got, and that totally changes the dynamics. So you have to be super careful about that in microcap companies, and on top of that, they almost always have very strict covenants. So I try to avoid that at all costs. So I'm looking at the balance sheet for that as well. The other interesting thing to look on the balance sheet for in microcap companies specifically is you'll often find a non-core asset sitting on there, and they don't even. A lot of times the management teams don't even fully realize the value of what they're sitting on. They're, oh yeah, we bought this. We bought our headquarters in 1970, and it's depreciated down to zero. But it's in Texas, right next to where they're about to build a Tesla plant. It's like you can have a significant non-core asset on the balance sheet that's just being totally missed in any screen or any book value calculation. So I'm always looking at that as well. And you'd be surprised, or at least I was surprised at how often that was occurring. But yeah, I think to really answer your question, I'm looking at something that's eventually going to be a 10 PE ratio or less. And I'm thinking, when I think PE ratio, I'm not thinking net income, I'm thinking free cash flow to equity, because I think that's really the most true measure. Net income you can mess around with a little bit. Free cash flow is the actual cash getting generated by the business.
Right. Yeah, it's much harder. I love Buffett was talking in this meeting about how he focuses a lot on the balance sheet, and because he said it's a lot harder to manipulate.
That really stood out to me as well. He said that's the first thing he looked at, and I think this was Berkshire meeting number 6 or 7 for me, and I've read I don't know, countless Warren Buffett books, and I'm not sure I've ever heard him say that.
I hadn't either. That really jumped out to me.
But it rings. It sounds like something Ben Graham would say, so it doesn't surprise me. But that was, of the entire meeting, other than the last 5 minutes, obviously, that was the thing that stood out the most to me. So,
yeah, for sure. I'm going to come back to that for just a second, but a question that just popped into my head: how do you think about is investing in small / microcaps more volatile than investing in large companies, or is it more of the lack of liquidity that's the bigger issue?
I think it's more the lack of liquidity. I guess they kind of go hand in hand. I mean, I think I got, however you want to look at it. Now I look at it as fortunate. I started the fund January 1st, 2020.
Yeah. Oof.
My first quarterly letter, we were down 30%.
Only? That's still pretty good.
Yeah, because obviously COVID had hit by then. And the way I look at it is I got lucky in the sense that one of the questions I always had in the back of my mind was, how was I going to handle a downturn? Because I've been in private equity before where there's less volatility, I guess you could say. And that was, I'd always question that. How am I going to handle a downturn? And, I think I've mentioned it many times. There's a lot of things I'm afraid of. I hate flying. There's plenty of things that give me.
Oh, you hate flying?
Hate flying. Yeah.
Oh, wow. That's funny.
Yeah. I mean, I've gotten better at it, but I'm certainly, whenever the plane starts to shake, I certainly grab onto the handles. But for whatever reason, when the market went down 30%, I mean, I wasn't having fun, but it didn't really bother me much. I looked at it as an opportunity. And I think this volatility or lack of liquidity, however you want to look at it, you can look at it from a pro and con standpoint. So I think the pro standpoint is that all of a sudden you can have, whether it's through a divorce or for various reasons, you can have a major shareholder, whether wealth was distributed from one generation to the next, a major shareholder wakes up one day and they decide they want to sell 5% of a microcap company for reasons totally unrelated to the business. It's actually happening to a company I own right now that just yesterday went down 20%, and there's nothing new has developed within the company. And you can look at that and get upset or say, I have an opportunity to lower my cost basis by 20% and nothing material has changed within the business. And I can't think of any other public or private market in the US that offers you that opportunity. Almost always, if you're buying at a 20% or 30% downturn in the price, it's because something has happened. Maybe it will end up being something that wasn't actually that risky, but it's because something has happened. In this case, it's just because someone woke up and decided maybe they wanted to build a pool or buy a new house. So they bought, so they sold 5% of the company. But I mean, it obviously cuts both ways as well. As I've mentioned, you can't wake up in the morning and say, I want to sell my entire position. So that's why you really have to do the rigorous due diligence up front. And there are more and more niche brokers that are popping up where if you do run into a certain situation where you've misdiagnosed the management team, or you invested in a restaurant that now says they want to build water parks instead of a restaurant, they just do a complete left turn out of nowhere. They will help you to find liquidity if possible, but it's not a situation you want to get caught in. But I think if you can look at it as an advantage versus a disadvantage, there's a lot of companies that we ended up doing so much better in because of just indiscriminate selling, that we were able to lower our cost basis by a significant amount. And if you know the company better than anyone else, and you can call the CEO and the management team and say, I'm just making sure nothing public has been filed that I'm missing and everything's okay, right? Like,
Right.
You all are still alive. If you know the company better than anyone else, you know that nothing wrong has happened with the company. And it really is just a free opportunity to lower your cost basis.
Yeah. That would be lovely, wouldn't it?
Yeah.
So I guess to go back to the Buffett thing, what are your thoughts on him stepping down?
Yeah, it was interesting. We were there at the meeting, and when he said we have 5 minutes left, or he said I can read the 5-minute warning sign that the meeting's about to end, so there's something important I need to tell you all. I was like, oh no. I knew I had a good feeling where this was going. But it was interesting because, at first he said at the end of the year, I recommend that Greg become CEO. And then he just couldn't fully commit to saying he was completely stepping away. He was like, but if there's a huge market correction or they really need my help in one area, I'll be back. I'll come back. But I think, I had two emotions at once. It's sad to see, you have Charlie passing away last year, basically a year ago. And then you have Warren stepping down. It's like two of my mentors and the people or not mentors, but people I've looked up to and try to model my life after have, come to an end of their career more or less. And so that part was sad. And you could see people getting emotional in the crowd for sure.
Yeah.
It's an end. It's hopefully not the end, but it's at least for Warren, it's the end of it. Just an incredible story that's I'm not sure will be ever replicated again.
No.
Or I can't imagine, maybe 100 years from now. But I mean, I think it was a smart decision as well at the same time. You could tell when he got up, he was walking with a cane. You could tell, I mean, they own, I think, 60 plus operating companies. There's just no way he's able to visit all of them in person anymore.
No.
And I think my suspicion would be is he doesn't want the transition to happen from him passing away. He wants to be able to now be the Charlie Munger to Greg for the remainder of his life. And I think that makes a lot of sense. So he made the right decision. It was just sad. It was just sad to watch.
Yeah, for sure. It's, it's certainly an end of an era. And, I feel fortunate to have lived during the time that he's been doing this so that, I could experience it firsthand. Fortunately, I never was able to attend a Berkshire meeting, but I've certainly watched all of them and I've read everything, and he's had a huge impact on my life. And I know he obviously has on yours.
Yeah.
All right. So I guess how do you feel about, let's segue back to something else,
Yeah.
portfolio allocation? Like, how do you think about that? I know you mentioned on your website, 8 to 15 companies
Yeah.
is kind of your ideal. Like, how did you decide on that? And how does that work with how you try to operate?
Yeah, sure. I think it's kind of because of two reasons. I think one is there's a very small pool of what I would call wonderful businesses of what I've already described, excellent management teams in niche markets, niche fragmented off the beaten path markets that exist. There might only be 50 companies in the US microcap US universe right now, and some of those are probably overvalued. So I think there'll always be enough for a 10 to 15 company portfolio, but maybe not that much bigger than that, to be honest. The second is more of a constraint. I want to visit every management team that we own in person once per year. I want to talk to them once per quarter, and I want to write a detailed letter twice per year for my investors. And I really feel like 15 companies is kind of the bandwidth of where I can really have a deep understanding of each company. So I think that's kind of how I think about why there's anywhere from 8 to 15 companies. And then so that's how I got there. And as far as position sizing goes, the real way I think about it is downside protection. So the largest holdings in our company, in our fund, are going to be companies that I feel like, I'll use the example of Citizens Bank where it's this quirky situation happened in a community bank where they got this incredible loan and they had more cash in the holding company than the book value of the bank or than the market cap by a tremendous amount. So even if we woke up tomorrow and it was announced that every single branch of Citizens Bank had been closed down, we would still make an adequate return. So companies like that, I have no problem pretty quickly making 12 to 15% of the fund. 15% would probably be the cutoff. And then companies where it's a little more growth oriented. I mean, I still am always a value investor at heart, but those are tend to make more of a 5 to 7% position. And if they do perform as I expect they will become a 10 to 15% position.
Oh, okay, that makes a lot of sense. So, is it a hard, fast rule? Like, if you come across the greatest business ever and it's number 16, are you going to be like, no, it's over 15, or we would be willing to push the boundary a little bit?
Yeah, it's not a hard and fast rule. It's more just how many companies can I personally keep up with. And I got really lucky because position sizing the first year or two of the fund was something. Sizing and portfolio construction was something it's not that I wasn't taking it seriously. I just wasn't putting very much deep thought into it. I was just flying around the country, trying to find wonderful businesses. And I got really lucky that I have a mentor here, for lack of a better word, in New Orleans, who ran a microcap fund for, I think 30 years for T. Rowe Price. And he just happened to have retired and moved back home here to New Orleans. So we talk about the companies that I'm considering buying, but this is where he pushes me a lot here, is on portfolio construction and position sizing. And it's been extremely value add to have him on board, is because it's something that when times are okay, you don't have to really think about, or I think about less, but when there's a market sell-off, you do start to realize, okay, some of my companies are way more correlated to each other than I realized. And he really pushes me back on thinking about those types of things as well, which I really appreciate, because it's not something that is the first thought that comes to my mind. But there's no hard and fast rule, but it just feels like 10 to 15 companies has always been where the fund has settled at.
Yeah, that makes a lot of sense. And it's awesome that you have somebody like that can help guide you through some of those decisions. I feel like that portfolio construction is probably something that doesn't get discussed enough.
Yeah.
And it's certainly not an easy skill to acquire. So it's awesome you got somebody you can lean on to give you some guidance.
Yeah, he's been extremely helpful because I'm really more of a qualitative person. I mean, I'm obviously thinking about valuation, but he's very much helped me a lot. And I agree, portfolio construction is not thought about enough, and he's really helped me. We meet once a month, and he really helps me. Reminds me to pay attention.
Gently, I'm sure.
Yeah.
Oh, that's awesome. All right. So we've been talking for a little while now. I want to give you a chance to talk about your fund, what you got going on there, where people can find you if you're on socials, what other things you have going on.
Yeah. I guess the easiest way to find is riveroaks-capital.com. And I'm also on X under my name, Whit Hughley, Huguley. I put out two letters a year, but then also try to send out something probably about once a month to anyone that subscribes to the website or the newsletters from the website. Yeah, and I'm always looking for investors. So I think growing the fund, it helps on the suggestivist investing side, obviously, and it's something I've been more putting a lot more effort into the last 2 years. Now that I've hit that 5-year track record, yeah, I appreciate your time and letting me talk about microcap companies, and I hope it helped you understand it a little better. But yeah, if you want to visit my website, my email's there, my phone number's there. I'm happy to always talk about microcaps with anyone.
And he might even fly to see you.
Great.
Yeah, I will put all those things in the show notes so people can easily find them. I do want to give a plug to you because I noticed that you're a great writer. I really enjoyed reading your stuff, and it's very interesting and educational. I learned a lot by reading them. You're obviously a smart dude, and I appreciate you taking the time out of your day to come educate me and the people that listen to our show. And number 3 is you've been killing the market, so you've been doing a great job. So just keep doing what you're doing. It's awesome.
Yeah, thanks so much, David. That was a ton of fun. I really appreciate it.
Yeah, you're welcome. All right. Well, with that, folks, we will go ahead and wrap up our show for today. Thank you for listening, and go out there and invest with a margin of safety, emphasis on the safety. Have a great week, and we'll talk to you all next week.